Good morning and welcome to the Ned Group Investments Insights webinar on the SA listed property sector. Thank you very much for joining us today to hear about what's been going on in quite a turbulent sector and what might be going on into the future. My name is Robin Johnson. I'll be hosting today and I have the pleasure of introducing Ian Anderson, portfolio manager of the Ned Group Investments Property Fund, and I'll introduce him further in a moment. Now, we titled this webinar Disruption and Evolution within the SA listed property market. Because of what's been going on around the world and in SA, we see that we're unsure about what the property demand is going to be into the future. And the disruption and the evolution will be linked to various sectors, and most predominantly the biggest sectors within the SA listed property market, such as office and retail. Now, disruption has led to fluctuations, big swings in the prices of some of these underlying businesses. And you've seen in 2020 that the SAPI fell 35% by the end of the year after a Q4 rally. Now, in the last month, in April, you've seen a huge gain on the sector, returning 11%, which has pushed the 3-month return for the SAPI relative to the Aussie index to outperform by 14%. Yes, 14% outperformance of the SAPI versus the Aussie in the 3 months to the end of April. Now, that's pushed the 6-month outperformance of the sector to 27%. And now, even over 12 months, you see that the SAPI has outperformed the Aussie by 4%. Now, part of this recent resurgence could be the introduction of some M&A activity. And we've seen a number of businesses go under cautionary in the last few months. Now, under cautionary means that the management knows some information material information about the company that will potentially move the share price in a significant manner. So that suggests that the deep discount to NAV within some of these property businesses is attracting new entrants or attracting merger activity to make efficiencies of scale by pulling some of these businesses together. And perhaps Ian will touch on a few of these in his talk. Now, dividend growth does remain lackluster within the sector. From many years of significant returns, good dividend growth, good yields from the sector that people have been relying on, we've had a really poor time of it and decreasing income returns in 2018, 19 and 2020. Now, we should see a resurgence in this or a big kick up because of the low base effects from April and May 2020. Now, that does remain to be seen. Now, coming on to our webinar today, we have the ability for you to ask us some questions, which is a bit of a new feature, so I hope it works. I have the questions that will come up here in front of me on the screen, so you can ask as we go through, and I'll hold those questions to the end. I will get the opportunity at the end to throw some testing questions at Ian myself, but please feel free to fire some questions through that I can pose to Ian and they'll come up here for me. And you'll see the link at the bottom of your screens. You just click through and type in your question. Now, Ian Anderson is our dedicated expert on the SA property market. He's been managing the Ned Group Investments Property Fund since inception and has done an incredible job of managing that portfolio in a differentiated way to the rest of the index and to the rest of the peer group. So I'm going to hand on to Ian now. Thank you very much for joining us, and he's going to take us through a presentation before I get that opportunity to test him with some questions. Thanks, Ian.
Thanks very much, Rob, and good morning, everybody. I think the sort of tone of today's presentation, I think initially when I started to think about this, and this was a little while ago, I wasn't quite sure how to position it. Normally, I'm very bullish and optimistic about the prospects for listed property. Obviously, the last 2 or 3 years has certainly tempered that enthusiasm somewhat. But I think what happened in April, particularly around all of the news from the listed property sector, the positive news coming out of the listed property has got me excited about the sector again. And I think one of the most pleasing aspects has been a far quicker recovery in the income than I had anticipated. Now, in this particular presentation, I'm still talking about lackluster growth, but subsequent to me putting this presentation together, we had a very pleasant surprise from one of the biggest counters we own, Distributable. We'd been expecting them to pay a dividend of around about 27 cents for the first 6 months of this financial year, and they're actually going to pay us a dividend of 45 cents. Now, for those of you that have followed Distributable, you could have actually bought that business at 60 cents a share a year ago. So the share, not only has the share price gone from 60 cents a year ago to R3.50 today, but you're going to get around 90 cents or potentially 90 cents of dividend. So if you'd bought it at 60 cents last year, the dividend yield that you were acquiring at was 150%. And I think that more than anything emphasizes just how significant or how sort of radical the sentiment has been in the listed property sector, and how much of an influence that placed on prices. Last year, nobody wanted to know anything about listed property, and there was just indiscriminate selling. In fact, one of the stockbrokers referred to it as lacking finesse. And what has happened now is on the way up. We've also seen this lack of finesse as people realize there's significant opportunities in the sector, particularly if we have businesses that get taken private or there's merger and acquisition activity. And so they now suddenly want to jump into the sector. So one of the big sellers of listed property last year, the PIC, is now one of the biggest buyers. They according to Anchor, they bought about 1.3 billion rands worth of listed property stocks in April alone. And that followed, a few months prior to that of also $1 billion plus of investment into the sector. But just to quickly have a look and see how the sector has, or how the fund has performed relative to the sector. And this is a chart showing the Ned Group Investments Property Fund versus the SAPI index. Goes back to the end of 2019, the beginning of 2020, so prior to the impact of COVID. And you can see that by the time we get to March, the listed property sector has halved in value. The Ned Group Investments Property Fund didn't suffer the same downward movement because we own different stocks to what was in the sector. And as a result of that, we didn't see the same huge decline. But importantly, we are now also enjoying this significant recovery that Rob alluded to, which started around November of last year, November last year, and has resulted in a substantial move, such that now, since the end of 2020, the price or the property sector is now down just 20%. I mean, there's still a long way to go. We do anticipate that we will recover all of last year's losses. Certainly the M&A activity is definitely helping out. Just look at an attribution analysis of the last 12 months to see what has made a positive contribution. Importantly, it's been some of the smaller, because that's the type of stocks we own. It's obviously been some of the smaller businesses, dominated by the likes of Fairvest and Safari. Those were businesses that predominantly invest in convenience retail. Arrowhead and In Blue Place have recently become the target of corporate action, and as a result, we've seen share prices move quite substantially. And then Tower is also under cautionary at the moment and has resulted in some significant price action. The only two detractors in the portfolio was Delta, which was a very small detractor, and that's because it spent a bit of time suspended and therefore hasn't enjoyed the huge rally that the rest of the sector has. And then Grit, which is our only non-South African business in the portfolio, with the rand strength over the last 12 months, has underperformed the rest of the South African stocks. Year to date, again, it's dominated by companies that have gone under cautionary recently. Arrowhead, Tower, Distributable, all under cautionary, and then businesses that have also produced results that are substantially better than what the market had anticipated and or resumed dividend payments. And Distributable and Octodec fit into that category. Safari was the only detractor from the performance this year. It was the best performing REIT in South Africa last year. It was actually one of very few REITs that was up in 2020, and I think now investors have, it's obviously the rest of the sector is playing catch up. So if you look at just the extent of some of the moves that we've seen so far in 2021. The two companies that have produced negative returns, Safari and Distributable A, down at the bottom, but pretty much all of the other REITs have produced substantial positive returns. We recently added Emira to the portfolio before this big run up we've seen in prices. Distributable and Arrowhead are both big positions in our portfolio, as are Octodec and Indlu Place, as is Accelerate and Tower. And you can see that, even when you get down to the bottom half of that table, most of the companies have produced returns of between 10 and 20%, even the bottom performers. But we've seen this strong surge in prices, while at the same time we haven't exactly seen a strong recovery in income levels. Yes, we do anticipate that the distributions from the portfolio will grow by more than 50% in 2021, and then grow by about 7 or 8% in 2022. So we're moving back towards that inflation hedged growth in income. What I do want to point out is that this slide was put together before Distributable gave us their trading statement, before they updated the market in terms of their dividends and for the year. As a result, these numbers are now understated. So the 2021 and 2022 distributions are understated by about 0.5%, which is almost a 1% additional yield that the fund is going to produce for investors. So yeah, my initial comments around income recovery is likely to take longer. Well, maybe there are one or two businesses that will defy that statement and will actually produce substantially stronger distribution growth. But by and large, it is going to take a while longer for the sector to recover to the levels we saw, or income levels that we saw in 2018. In fact, I think we probably only really should be targeting the level that we had in 2019, so getting back up to around 10 cents per unit in the Ned Group Investments Property Fund. So why is this income recovery taking a little bit longer? I mean, prices are obviously running because of the prospect of corporate action, not necessarily because of an improvement in fundamentals. Bearing in mind that when we started with this big downturn in 2020, most of these companies were already trading at fairly hefty discounts to net asset value. So those discounts have just got increasingly wider. But what we do know today is that we are going to see increased vacancies and lower market rentals, particularly in office properties, but also some of the large mall landlords are reporting lower occupancy rates. However, it does look as though March was a particularly good month for retail sales following a very strong February. The money that people have saved by not consuming services are now being spent on goods. And as a result of that, we've seen a fairly strong recovery in retail sales and not just sales online, but sales in malls as well. But I think it's not going to be sustained. It's probably going to be fairly short-lived. I do think that both office and mall landlords are going to continue to struggle in this new disrupted world. Unfortunately, while vacancies are rising and market rentals are falling, costs are also rising. We know that inflation is likely to start to accelerate in the second half of this year. This morning, Chinese producer prices rose by almost 7%, and that's going to filter through into the rest of the world. So utility costs, security rates, and cleaning costs are all rising above inflation while market rentals are falling. Companies are also looking to preserve as much cash as possible. There's still some uncertainty around where property valuations are going, so you want to strengthen your balance sheet. That means paying out less of your distributable earnings as a dividend. For those of you that know the REIT sector well, you'll know that REITs have to pay out at least 75% of their distributable earnings as a dividend each year in order to retain their REIT status. Historically, they've paid 100%, so there is quite a lot of leeway for them to reduce those dividend payments all the way down to 75% payout ratio, retaining 25% of distributable earnings, and thereby strengthening the balance sheet. And some companies are delaying the payment of their interim dividends until the end of the year or till the end of their financial year. And then some businesses that are really struggling from a loan to value perspective or an interest coverage ratio perspective have been able to use the Companies Act and defer the dividend payment. So they're still able to retain their REIT status, but they are able to use the Companies Act to not pay any dividends. Some landlords, particularly in retail, are still providing rent relief, but this is becoming less and less significant. And importantly, as these rental discounts are removed and the relief is removed, it's going to put those tenants increasingly at risk. So a lot of the tenants are only surviving today because of the amount of relief that they received from their landlords. In fact, South African REITs provided over 3 billion rands worth of rental relief to their clients, or to their customers last year, to their tenants. I mean, that is a significant amount of money. Globally, we've seen a similar amount of relief given by landlords, but importantly, in most other countries, the government then came in and supported those landlords. There's been absolutely no support for landlords from government in this country. And then, one of the reasons why we are seeing these increased vacancies and lower market rentals in office and malls is because of this, the increase or the acceleration in some of the trends that have been disrupting real estate markets globally for some time now. How we work, where we work, how we shop, and how we are entertained is all evolving, and it's having a major disruptive impact on real estate markets. But despite this slowdown or the slower recovery in income, we have seen a much stronger recovery in prices, and a big chunk of that is being fueled by the prospect of corporate action. And there's a long list of companies today that are under cautionary or have already announced intentions to be merged or to be acquired. If you look at the current positioning of the portfolio relative to SAPI, not a heck of a lot has changed. What I do want to highlight here on the right-hand chart is just the high percentage of exposure that South African REITs have to shopping malls and to offices. It's significantly higher than you'll see anywhere else in the world, where those other sectors like industrial and storage and residential are also very, very big components of their market. In fact, in most other markets, residential is one of your top sectors, followed by industrial. Here in South Africa, 77% of our market is dominated by retail and office, where you've seen the most disruption and the most pain. Now, the Ned Group Investments Property Fund has obviously taken a slightly different position. It's one of the things that we set out to do right from the get-go. We don't necessarily have to look like the benchmark or the index. We can pick and choose where we want to be invested. We want to be invested in sectors that are relevant rather than the old adage of quality. One of the reasons why the South African listed property looks like it does is because, over the last decade, quality has been defined as big shopping centers or big offices. I think that has started to change now, and people are looking more towards relevance. You will notice, though, that we do have 47% exposure to retail, so it's still a big allocation in the fund. But importantly, the manner in which that is made up is very different to what you'll see in the SAPI index. So the SAPI index is dominated by malls that are over 50,000 square meters of GLA. So those are regional and super regional malls, and then followed by 35% allocation to your 25,000 square meter to 50,000 square meters of GLA malls. So those are sort of not convenience or neighborhood, but they are still substantial. They are probably in neighborhoods, but they're still substantial shopping centers where there is pressure on occupancies and rentals, and then just 24% in smaller malls servicing neighborhoods and offering something like a convenience offering. The Ned Group Investments Property Fund, in stark contrast to that, has most of its exposure in convenience and neighborhood, and that has done substantially better over the last year, and is likely to do increasingly better into the future. The disruptive forces like online retailing don't impact that particular segment of the market. They have the biggest impact in the 25,000 plus GLA centers. And you can see in Fairvest Property Holdings is the largest position in our portfolio. It is dominated by convenience retail, non-urban, so it's in rural areas predominantly. And if you look at the distributions that particular business has paid, between 2018 and 2020, there was a slight uptick, and we expect growth in 2021, 2022, and 2023. Compare that to Hyprop Investments, where distributions have more than halved and the recovery is likely to be a lot lower. In fact, this morning, Hyprop have announced an accelerated book build because they're in desperate need of capital, and they're prepared to issue those shares at a massive discount to net asset value in order to continue to operate as a business. So we continue to favor the convenience retail over the mall landlords. But it's not just convenience retail in the portfolio. We obviously like industrial and warehouses in particular, where again, warehouses are performing significantly better than your let's call it run-of-the-mill property or your diversified property businesses like Redefine. Equitas Property Fund, another big holding in our portfolio, is likely to produce distribution growth, or has produced distribution growth, uninterrupted distribution growth from 2018 to 2020, and that growth is expected to continue all the way to 2023. In fact, we are expecting an acceleration in growth in 2022 and 2023, and compare that to Redefine, where they didn't pay a dividend in 2020. We do anticipate that dividends will resume this year, although the company hasn't made any announcements yet around the magnitude of the dividend that they are going to pay. So just in terms of my final slide, one of the things that we do see, and this is a forward-looking now, I think these large discounts to net asset value that have persisted now for the last 3 years are starting to become very attractive, and we are seeing a number of businesses go under cautionary, as I've already mentioned. I've listed some of them: Arrowhead, Attack, Tapula, Fairvest, Tower. Fairvest and Arrowhead are involved in the same discussions. Fairvest is looking to acquire Arrowhead. From what we understand, it was driven by Arrowhead. The four largest Arrowhead shareholders approached the management of Fairvest with a view to taking that out. So it's not just being driven by the companies themselves or by outsiders. It's also being driven by the biggest shareholders in some of these businesses. If you look at the yield on the sector today, the historic and forward yield is around 8.5%, which doesn't look that attractive, but you need to bear in mind that includes a number of companies that didn't pay any dividends, or companies that have moved their dividend payout ratio down to 75%. So the actual distributable earnings yield on the sector is still quite attractive. If these companies start to move back to payout ratios of somewhere between 85% and 95%, and some will probably still be able to maintain payout ratios of 100%, then we will see a much stronger acceleration in dividends in the years ahead. As I mentioned already, this year we anticipate distributions to grow by over 50%. We've already collected a lot of dividends in the second quarter. The second quarter distribution is going to be substantially larger than the first quarter, and in fact, we've already collected more dividends in the second quarter than we did in the first quarter. But we know that payout ratios are likely to remain lower for longer. At least for this year, most companies are going to pay between 75% and 80% of their distributable earnings. That is going to have an impact on the amount of income you receive. But I do think that number moves to somewhere between 90 and 95% by 2023. And so that in itself will provide substantial growth in dividends for the sector. And then I had this in the last notes that I communicated into the market. There was some talk that some companies may opt to forgo their REIT status. There have been some questions asked of whether the REIT wrapper is actually an appropriate one for property. I think at the time, most of the property companies were very worried about valuations and occupancies, and they were really struggling. I think that risk has subsided somewhat, and so we would place a very low probability on companies willing to forgo their REIT status. With that, I'll hand back to Rob for the Q&A. Thank you very much.
Thank you very much, Ian. That was extremely interesting, and I do have a few questions on the back of that presentation. Just a reminder to everybody listening in, though, there is a link at the bottom of your screen where you can click through and submit a question for us. I've had a couple through already. One of those I'll hold till the end. But I'd like to kick off just by digging into this income and the distributions. And you gave us quite a good understanding of why the recovery in distributions might be a bit slower than you would like. But you also painted a nice picture for the likes of Fairvest and Equites. So, but what are the threats to those distributable incomes going forward? You know, what could be the hiccup in that area to affect your forecasted distributions?
Yeah, I mean, I think the main thing would be a significant slowdown in the recovery and economic activity. I mean, those two businesses represent the lifeblood of an economy. It's, you know, Equites is involved in warehousing, so if goods are moving around the economy, then demand for that product is going to be high. With Equites, the likelihood of a drop in earnings is very low because their average the weighted average lease expiry for that business is now almost 15 years. This is a company that signs 10 and 15-year leases. So I think with Equites, the risks are very low. A business like Fairvest, where it's predominantly convenience retail in rural areas, I think the biggest threat there would be a substantial slowdown in the growth on government grants, because that clearly has been beneficial. However, countering that is the fact that a lot of those properties are in areas dominated by mining communities. So the massive growth that we're seeing, or the surge that we're seeing in commodity prices, is another tailwind for those types of properties. So we think that the risks there are low, but they're not zero. The main risk for Fairvest would be a substantial slowdown in social grants. I just don't see that happening anytime soon. You know, the government needs to keep its constituents interested. There's an election coming in a couple of years' time, and so I think that will continue.
Thank you. And you mentioned the payout ratio conundrum, if you like. What I can't understand, and I think if you look globally, it's very rare to see REITs paying out 100%. And if we wind back a couple of years, they were paying out more than 100% in South Africa. But you know, I can't understand why a REIT would opt to pay out 100% of their distributable income if they had the option to shore up their balance sheet to be a more sustainable business into the future. Surely this is an opportunity now to stop making such a big payout and have a more conservative or sustainable business. What's your views on that, and why would they go back to 100%?
Yeah, so I think the only way that they go back to 100% is if there's activity in the portfolio. In other words, they're able to recycle capital, which they can then use to do the OPEX and CAPEX that's required to maintain their portfolio. The reason why they've gone to lower payout ratios now is because all other sources of capital have dried up. It's very difficult for them to raise additional debt because LTVs are high and interest coverage ratios are too low. They can't raise equity, or they shouldn't be raising equity, because the discounts to net asset value are so low. And at least last year, there were very few buyers for their property. So it was very difficult for them to recycle capital. And for that reason, they've been forced to go to lower payout ratios. Once the markets start to free up, and once they're able to start raising debt again, or they can raise equity, or they can sell properties, then those that are able to do that will probably revert back to 100% payout ratios. But we would think that as an industry, the move is going to be around 90%. So our long-term view is that payout ratios will stabilize somewhere between 90 and 95%. They will become more flexible. So depending on what a company requires in any one year, and depending on what they can raise externally, they might say, well, this year it's going to be 95%, or this year it's going to be 100% because we sold R1 billion worth of properties, and so we need to return some of that capital to our shareholders. But if they don't do any of that, then they can go as low as 90%. I think that's going to make forecasting dividends slightly more difficult for the sector going forward, because of this variation in payout ratios. But I think it's prudent for them to have lower payout ratios than 100%. Absolutely.
Thank you, Ian. And we have had a few questions come through now. One of those is on future expected cash flow yield. I guess we're talking about the fund. We're looking at what's your forward-looking yield on the fund over the next 12 months. And also with there's a question on whether your recovery thesis for the local market will be the same if you look around the world, because you also manage a global property fund.
Yeah. So on the first question, yeah. So the forecast, the yield on the portfolio is 13.5%, and following Dipula's announcement, that's sort of in the bag now. We think. I mean, Dipula was probably the stock that we would have flagged as the one least likely to pay a dividend, and it's the one that's going to pay us twice as much dividend as we'd originally anticipated. We've been very, very conservative in terms of our forecasting, so we're not expecting dividends from Rebosis and Delta and maybe one or two other companies, but importantly, from a Dipula perspective, we'd forecast that they were only going to do 45 cents for the year, and they've given us 45 cents in the first 6 months. From a global perspective, so that 13.5% yield, we're reasonably confident about that, given what we've already collected and what we anticipate collecting going forward. In terms of the global recovery, it's been significantly better than the South African recovery because of the nature of, or the makeup of their markets. They are not dominated by shopping malls and offices. Those markets are dominated by residential, by healthcare properties, by towers, by data centers. So property types that have actually benefited from COVID, as opposed to those ones that have been substantially disrupted. And that's why I mentioned at the beginning that South Africa, unfortunately, the positioning of our REITs has been poor from the types of properties they own. It's not their fault. That's sort of where everybody wanted to invest, and so they're predominantly in offices and malls, both here in South Africa and globally. We've already seen a substantial recovery in property prices globally. If I look at the property fund, the global property fund we manage, I think the 12-month return now in US dollars is almost 50%. So we basically back to the price we were pre-COVID. In South Africa, we've still got room to move, and we think it's going to get there. And the reason why we're optimistic about South Africa getting there is because of this M&A activity. We know that there are companies out there today that are trading at 20 to 30% discounts to the prices that are going to be offered for those businesses. We have signed letters, we have signed irrevocables, and so we know this, and we know there's going to be substantial upside. I mean, if I just look at what we've signed and what may happen, bear in mind, it's not guaranteed. There's at least another sort of 7 to 10% upside from current prices in the Ned Group Investments Property Fund, not the market, because these are companies that are not part of the SAPI index. You will typically not find these businesses in the other portfolios, other property portfolios out there, but they are big constituents of the Ned Group Investments Property Fund. So we're confident about the short-term prognosis for the Ned Group Investments Property Fund based on the information that we have at our disposal today, having signed letters committing to particular acquisitions.
Never let anyone
I'll leave
tell
it
you.
at that. I can't,
never let anyone tell you miss an
that.
opportunity to advertise the fund.
Correct. No, but that's why I said that the last 3 weeks, the sort of mood in the listed property sector has changed palpably, and I think that's important. And the reason behind it is because we now have these external buyers hunting the bargains that are on offer in the listed property sector. You can go and buy a sort of a diversified portfolio in the market, so physically, and pay 100 cents in the rand for that property, for that portfolio, or you could buy a listed vehicle and pay 80 cents in the rand, and still give the shareholders 30 or 40% capital upside. So that's the opportunity that exists for these smaller property companies today.
Thanks, Ian. We've had a few stock-specific questions, so I'm going to skip over all our pre-prepared questions and get into some of the questions that have come through. And there's a couple on Delta, and you touched on it in your presentation, but would you just kind of give us a quick update on what's happened very recently and what you expect?
Yeah, so
maybe when the suspension might be lifted.
So the suspension is expected to be lifted before the end of this month. So the suspension, the JSE suspended the company because they withdrew their 2020 financials, and therefore we're no longer in compliance of the listing requirements, which means you need to have a set of financials at least no more than 6 months old in order to remain listed. They had some issues with the auditors in terms of completing the audit, so it took a lot longer than they had anticipated. They've now completed the 2020 financials. They've reported that. Surprisingly, given all the delays, the net asset value is actually 10% higher than what we'd anticipated. So we had worked on an NAV of around R5.07 a share, and it's come out at, I think, R5.53 or R5.54 a share. What we know now is that given the amount of time and effort that has gone into getting these financials out, there were at least 4 delays. The auditors delayed the publication of the results at least on at least 4 occasions. The cash flows were strong. The valuations have been thoroughly interrogated. The property portfolio is still worth almost 8 billion rand. Yes, they've got about 5 billion rands worth of debt, but there's still substantial value in this business which is not being recognized by the price. We're not quite sure what happens when the suspension is lifted towards the end of this month. They will have reported interims and finals for 2021. The interims and finals for 2021 will be released on the same day, and after that, the suspension can be lifted. Because of the strong growth that we've seen in the sector after the company was suspended, we think that there's some catch up there. And also there should be some catch up because now investors can rely significantly more on those financials. And then in our discussions with management recently following the publication of those results, we can confirm that government is now signing longer leases with Delta. In fact, I think it was a day or two before they chatted to us, they just signed a 9-year, 11-month lease with one of the government departments over a very substantial GLA. So, but we wait to see it's been suspended for so long. We're not quite sure what's going to happen to the share price when it opens up.
One of the things that you've been wary about over the years is SA companies investing overseas. There's been a question on Grit, which is obviously a Pan-African portfolio, but it's had its relisting, and you touched on it earlier as one of the detractors. It's had its primary list and moved to London. Is there anything you have to do in terms of the portfolio or the mandate, and are you still happy with it given its exposure to the rest of Africa?
Yeah, I mean, we probably, at this stage, we think that we maybe got too much exposure. I mean, it did incredibly well during 2018 and 2019 and became a significant holding in the portfolio. It was the top performing company in our portfolio over 2018 and 2019, and so it may be a little bit large now, and we would look to lighten it. I mean, clearly they are battling a little bit in Mauritius today because the hotels that they own are not operating, or certainly not operating at the capacity that they should be. But we anticipate a very strong recovery in Mauritian tourism once that opens. I think for us right now, it's the listing just changed, but the investment thesis didn't. So we're comfortable. We just would like to lighten it to maybe less than 5% of the portfolio. I mean, on the others, I mean, we have actually increased by virtue of our exposure to storage. Recently, the acquisition of Emira, to Equitas, we have got a much higher allocation offshore, though we're not doing it directly, we're doing it indirectly. But importantly, it's into the property types that we view as being relevant here in South Africa. So for Equitas, it's warehouses in the UK. For storage, it's self-storage in the UK. And Emira, it's convenience retail in the United States, which has actually held up a lot better than the other forms of retail. So it still talks to the same themes. It's just not in South Africa. We're not making investments globally, but the companies that we own are certainly doing it, and they've done it very, very well, in my opinion. The other stuff that we're avoiding are obviously the big shopping malls in Eastern Europe, where the threat of Amazon today is real. Amazon is about to move into Poland. A significant chunk of that Eastern European exposure is to large shopping malls in Poland.
And I guess that's a slight at Nepi Rockcastle.
Well, not a slight, but I'm just a warning. I mean, we chatted to management recently. They don't seem to be too phased by the imminent arrival of Amazon. But I think most mall landlords said that before Amazon arrived in their country, and 3 or 4 years later, they were in devastating conditions. So I think that's, we'll wait and see how it all plays out. There's this feeling that from Germany going east, people typically like to go to shopping centers. They like to buy stuff themselves. They don't like to shop online. But, when Amazon comes with their convenience offering and offers you groceries in 60 minutes, it changes how you think about online retailing in a big way.
Sorry, I was putting you on the spot there. One quick question on a view on Vukile.
So Vukile, we've got we were actually growing our exposure to Vukile a couple of years ago. It was one of the positions that we lightened quite aggressively last year, just simply because of its Spanish retail exposure, and the fact that there was a put and call option on the remaining stake in Castellana, which is the business that they own in Spain, which would have obviously been a major drag on the balance sheet. So I think, Vukile certainly had some balance sheet risks which management are addressing. I think things are starting to improve there quite dramatically. They've been able to renegotiate that option agreement that they had on Castellana. They've pushed it out 3 years, so that's taken one of the major risks in the business out of the equation. And then I think also importantly, they are doing other things in the portfolio to strengthen, other things in the business to strengthen the balance sheet. They have a lot of cross-currency interest rate swaps, which can be very risky when the rand is weakening, but obviously have benefited the business substantially now that the rand has strengthened so much. So the business today is probably in better shape than it was even 6 months ago, and we would certainly look at re-establishing our position in that business. In fact, it is one of the companies that we've earmarked as being a recipient of the cash flows that we are likely to receive from some of the businesses that we will be selling to private investors over the next sort of 2 to 3 months. And there's a substantial amount of money that will be available to be redeployed. So we, selling at yields sub 8, buying at yields of 10, 12% plus. So that's actually going to be a distribution enhancing, value enhancing for the portfolio as well.
Thanks, Ian. I'd just like to finish on a question. I realise we've run over time, but I do want to get your short and longer term views on the asset class in general. And we've had a few questions on what's the prospects for the rest of this recovery that you alluded to earlier as well.
Yeah, so I think you need to break it down, and I think I mentioned it a little bit in either in the one of the previous questions or during the presentation. I think if you look at where the sector what the sector's done, the forward yield in the sector today is 8.5%. Now compare that to long-dated bonds, which are at 9%, and with all the risks that are still inherent in the property market, you would think that the price recovery is sort of behind us, and I would tend to agree with that. If you are buying, Growth Point and Redefine and Nepi and some of the other big companies on yields of 7 and 8%, I think you don't have much room for error there. I think my short-term prognosis is that until we start to see a recovery in earnings and fundamentals, a lot of the price recovery for the sector as a whole is already behind us. And I don't see much scope for a huge move at a sector level. What we are clearly more excited about is the fact that you are still getting yields of 15 to 20% in the smaller businesses that we own, and those are the companies that are the targets of this M&A activity, and we can see substantial upside in the short term for those businesses. Hence my comment that just based on what we know today, there's somewhere between 7 and 10% price upside if all of those deals happen. And again, there's no guarantee that the deals happen at all. The longer term prognosis is I think a lot better, and that's because we will start to see a recovery in dividends from 2023 onwards, and that recovery will it will be in two forms. The first will be just a recovery in the businesses themselves, so the fact that the oversupply that we see in office today and maybe in retail will start to be absorbed. and we'll start to see a recovery in rental levels and occupancies. But it's also going to come as a result of an improvement in those payout ratios. So we give them maybe another 18 months for low payout ratios of 75% before we ratchet up to payout ratios of between 90 and 95%. I think when that happens, that will be the sort of next leg up for the listed property sector. So that's it's quite a long-winded answer, but it's almost the small cap stocks look very attractive right now because of the M&A activity. The overall market less so because of the strong recovery we've already seen, which hasn't been about earnings. But from 2022, 2023, we anticipate an earnings recovery to drive the sector.
Ian, thank you very much for your time today. I really appreciate it and taking us through the presentation and being very candid in your answers to the questions. Have a good one.
Thank you very much, Rob. Thank you.
Thanks very much. And just so in summary, we've seen a big price recovery in the sector. Is there much more upside there? Well, I think you heard from Ian there that you need a differentiated portfolio to the SAPI index on aggregate. Perhaps there's not much price recovery there. Into the future, you see a better earnings growth prospects, maybe 2-3 years out, as and when the payout ratios do go back to a more substantial level. But also, there's still an uncertain future in the retail and the office segment. So you do have to be careful in terms of what your exposure is there, and are you holding the right businesses with sustainable cash flow generation. On that note, I'm going to sign off. I'm going to say thank you very much for joining us today. The recording will be published on the Ned Group Investments podcast and website channels and YouTube channels. Please sign up to our LinkedIn feed. All of our invites, all of our news goes through there. Some educational things for advisors and clients to use as well. So please have a look at our LinkedIn page and sign up to follow us. And then join our Responsible Investing webinar next week on May the 18th, where we're tackling maybe a contentious subject of diversity, and is it actually leading to inclusion across the corporate segments around the world. And we've got some very interesting speakers joining David Levinson next week. Finally, thank you very much for all of you for attending, listening to me waffle on at the end here, and please provide some feedback with the QR code in front of you. We always look to make things better going forward. So once again, thank you and goodbye.